very distinguished lawyers and notable tax practitioners who will be taking us through today's session. My brief is to introduce them to you, and then I'll hand over to a young colleague, Precious, who will then take us through most of the housekeeping rules and indeed moderate the rest of the session. As you all are aware, the Practical Training Academy is a not-for-profit company that's dedicated to providing trainings for Nigerian lawyers and other professionals at no cost to them. Today's training will carry 1 CPD point, and everyone who is logged in on Zoom will get 1 CPD point without carrying out any further action. Now, before introducing Stephen and Falajimi, I will just kindly ask your indulgence to spend a minute to click on our YouTube channel and subscribe. And because we have all our slides and video on the YouTube channel, and we're actually encouraging our members to log in and join, subscribe to that channel. And it's really important to us. Thank you very much. The link is showing now on the chat box. So if you just take a minute and do that as a return favor to us, that would be nice. Stephen Chima Arubike is a partner at GLAS, a leading full-service business law firm in Nigeria. He graduated from the University of Nigeria with second-class upper honors and the Nigerian Law School with a first class, winning one of the overall best prizes. His practice primarily focuses on taxation, corporate law, and dispute resolution. He has advised the public and private sector, as well as local multinational clients, on the tax dimension of numerous seminal and complex transactions. He also represents leading global clients in significant tax litigation before the Tax Appeal Tribunal and Superior Courts in Nigeria, as well as during tax audits and investigations. Stephen began his law career at GLAS and has risen to the position of partner. At one point, he was seconded to Allen and Overy's office in Johannesburg, South Africa. He's recognized by reputable legal directories, including the ITR World Tax, Legal 500, and Chambers and Partners. Stephen is a regular contributor to both local and international legal journals. He's a fellow of the Chartered Institute of Taxation of Nigeria and a member of the International Fiscal Association. It is my pleasure to welcome Stephen Chima Arubike to today's session. I will also very quickly read Folajimi Akinla's CV. Folajimi is a tax lawyer with over 15 years experience in contentious and non-contentious tax, working in London and across West Africa. He led the West African tax controversy and dispute resolution practice in one of the big four accounting firms, a role in which he successfully acted for multinationals in precedent-setting direct, indirect, and international tax appeals. Folajimi's experience includes working in a big four in London, where he regularly acted for taxpayers in indirect tax appeals before tax tribunals and the administrative courts. He has interned as a foreign qualified lawyer at Gray's Inn Tax Chambers in London and recently completed a mini pupillage in one of the tax chambers in London. He is currently enrolled in the MSc tax course at the University of Oxford. Folajimi contributed to Nigeria's first transfer pricing regulation and was a member of the Inter-Ministerial Committee on Nigeria's first tax amnesty, the Voluntary Asset and Income Declaration Scheme, VIDES. Before specializing in tax, he worked in a law firm renowned for its litigation and dispute resolution practice and appeared before all superior courts of record in Nigeria. He's a member of the Chartered Institute of Taxation of Nigeria and has completed the Advanced Diploma in International Tax (ADIT) course by the Chartered Institute of Taxation UK. He holds a master's degree in tax law from Queen Mary University of London and is a graduate of the University of Lagos. I'm happy to have Folajimi here also today. So thank you very much. I ask again that you please subscribe to our YouTube channel. The link is showing on the chat box. For those who have questions and answers during the course of this session, please throw them into the Q&A box. I will now invite Precious to introduce herself properly and then carry on with the moderating today's session. Thank you very much, and I hope we all enjoy the session. Thank you. Precious, are you there? I can't see or hear Precious. Stephen, can you hear her?
I can't hear her. I can't hear her.
Okay. Just a second. Let's see what's going on with her. Okay. Precious, we are waiting for you. You are muted.
No, I'm not muted.
Okay. Go ahead now.
All right. Okay. Okay, so welcome everyone to the first to third day of the practical series, and thank you very much, Mr. Dina, for that warm welcome. My name is Precious Bochuku, and I would want to welcome everyone again to the third.
Sorry, Precious, you need to adjust your camera. We are only seeing your roof. We can't see you.
So I will just quickly glean through the three important housekeeping regularly guarantees 1 CPD point for all participants. And secondly, which is the experience of the subscription into the YouTube channel, because it creates an avenue to access various materials from esteemed speakers across different backgrounds. And then it's very important and very salient to iterate that your questions are very important and will be heard, particularly by 4:30 after the seasoned speakers have had their sessions. So ask your questions, join the YouTube channel, and we will have the first speaker to give us an introspection into the key taxes which are currently on our mind and which will come into force 1st January 2026. Thank you very much, Mr. Steve, the floor is yours.
Good afternoon, everyone. Thank you very much, Tobena and Precious, for the wonderful introduction. I don't know whether you can see me, please. Please confirm you can see me. Confirm also that you can hear me.
Steve, I can see you clearly and I can hear you, and I'm sure everyone can too. You've actually covered the entire screen very well, so that's good.
Okay, I think I need to save you. Okay. Okay, today we're going to look at key taxes in Nigeria. Everyone will understand that one of the burning issues in the country today is tax reform. So the question we ask ourselves, what are the taxes that we have in the country and what is going to change in the coming months? So because of time, we have selected 3 key taxes. One is income tax, The other one is a capital gain tax. And the third is a value added tax. That is not to say other taxes are not important, but we feel that if I ask anybody in this room about the taxes in Nigeria, they are probably going to mention payee. They may also mention VAT or withholding tax, as the case may be. So we have selected these taxes because of the importance they are to the economy. So I'm going to take you through income taxes. Poladimi will look at capital gain tax, and I will come back and look at VAT. Well, for purpose of time, I'm going to avoid areas that have been covered by the previous lecture because, of course, you understand that there are some area of overlap. So let me quickly share my screen. Please confirm if you can see my screen.
We can.
Okay. So I will skip I will go ahead to to take you through the introduction. Now, the income tax is a tax that I know most of us may be familiar with, either by the name income tax or by the name pay as you earn taxes. So principally in Nigeria, Nigeria taxes mostly companies incorporated in the country and also foreign companies that earn source income in Nigeria. The country also imposes tax on income earned by resident individual. So we have two primary tax statutes regulating income taxes, but there are more than that. And in the course of the lecture, we are going to look at other taxes. So when we say income tax, what do we actually mean? We mean those taxes that are mostly that apply to earnings, such as salaries, profit, dividend, interest, and commission. One of the key attributes of income tax is that it is collected periodically, either quarterly, annually, or sometimes through withholding. For example, pay as you earn tax, which I know most of you may be familiar with or might have, may be paying directly or directly as employers of labor or indirectly as employees. So income taxes can be progressive. It can also be flat. Well, Nigeria uses a flat income tax rate for corporate bodies. They use progressive rates for individuals. Now, income taxes differ fundamentally from consumption taxes, and we're going to look at the key distinction between income tax and consumption tax. Now, the key distinction is that income tax, as I have mentioned earlier on, is charged on income or income earned by either corporate bodies or individuals. On the other hand, consumption tax is charged when we spend money to purchase goods and services, for instance, VAT. So another key distinction is that income tax is direct. It is a tax that goes direct to the income of the individual. You pay it directly to the government. However, consumption tax is indirect. In fact, you hardly know that you are paying consumption tax until you look at your invoice and see a rate applied to the total consideration of the goods that you have purchased, for instance, VAT. So income tax is either progressive, as I said earlier on, it will also be proportional, but consumption taxes generally are proportional. You pay a certain percentage on the total consumption of the goods that you have either purchased or that have been supplied to you. Income tax, as I say, is periodic. You pay periodically compared to consumption tax, which is paid immediately. What do I mean by that? You don't pay, usually don't pay income tax immediately. If I earn, let's say, if I earn 50,000 naira from legal services, I'm not going to pay income tax to the government immediately in most cases. I may have to wait at the end of the year when I file my income tax self-assessment return, declare all the income that I have earned, not just that 50,000, and then I pay all the taxes at the applicable rate. But whenever you purchase goods or services, VAT will be charged on the consideration, and you have to pay it to the supplier immediately, and the supplier will take it to the government. So you pay income tax periodically, but you pay consumption taxes immediately. Examples of consumption taxes include VAT. As most of you know, we have import duties, hotel occupancy tax for applicable in Lagos, and fuel levies and surcharges. So this distinction is very crucial for tax planning. Now, what is actually income? When we say income tax, is it actually all the amount that come into your hand that you pay as tax? That is not the case. Of course, rumors have been going around that the government is going to tax the money in people's bank accounts. That is not true. You don't pay income tax on all the money or funds that enters into your account. You pay income tax only on income. You don't pay it on capital. Now, let me drive home this point. Most of you are aware that banks are raising money to meet CBN recapitalization exercise. Of course, they are raising money either through right issue or public offer. So all the money being raised through these methods will not be taxed because they are not income, they are actually capital. If those money, let's say a bank raised 50 billion naira, the tax authority will not impose a CIT rate of 30% on that amount, simply because it is capital, it is not income. So we normally use the metaphor of a tree and the fruits to differentiate income taxes from consumption taxes. So what the law imposes tax on is not the fruit, it's not the tree, which is the capital. The law imposes tax on the fruits that is derived from the tree. And judicial authority have been able to draw distinction between income and capital. Some of the earlier cases that we have in Nigeria is Aripco and the Federal Board of Inland Revenue. And just recently, the Federal High Court draw this distinction, and from that distinction, held that the taxes sought to be imposed on a company based on the property that the company has in the Federal Capital Territory, purportedly as a turnover assessment, as a turnover tax under CETA Section 30, is illegal because that tax is imposed on capital. It is not imposed on the income earned by the company. It is just merely based on the value of that property. However, if the company have rented out that property and derive rent as earning from the property, that rent, which is the fruits, as using the analogy, using the metaphor, will be taxed, but not the value of the property. So what the law taxes is actually the fruits from the capital, which is the tree. Now, what is the statutory basis for income tax in Nigeria? Some of you that attended yesterday's lecture must have, listened to Professor Odinkonibo. Odinkonibo, Prof, rightly mentioned that the statutory basis for imposition of income tax in Nigeria is the Constitution. And if you look at second schedule, part 1, item 59, it actually stated the authority to collect income tax in Nigeria, and elaborated more on that, specifically on item 7 and item 8 of the part 2 in that same second schedule. I will not dwell much on that. Rather, I will go ahead to discuss the laws that the National Assembly has enacted over time to impose income tax in Nigeria. Now, some of you may be aware of some of these laws. We have the Personal Income Tax Act, we have the Company Income Tax Act, Tertiary Education Trust Fund Act, the Petroleum Profit Tax Act, and so many of them. I'm not going to mention them. I've listed them in the slide, which I will share later. And finally, we have the Nigerian Tax Act, which also imposes income tax, such as PIT, CIT, petroleum profit tax, hydrocarbon tax, and the economic development levy. We have listed all the income taxes that we currently have in Nigeria, and also mention the current regime that will take effect January. I've also listed the rates for the income taxes. What the current law reform committee has actually achieved is to ensure that we have a unified law for all the taxes in Nigeria, including the income taxes, because there are several of them. So some of the taxes that I mentioned in this table, for example, the tertiary education tax, the Nigerian Police Trust Fund levy, National Information Technology Development Agency levy, National Agency for Science and Engineering Infrastructure levy, has been consolidated into a single levy called Economic Development Levy, charged at 4% of the accessible profit. It's just to avoid the duplication, because the multiplicity of income taxes that we had under the current regime that we phased out come January 2026 creates uncertainty, compliance burden on the taxpayer. So instead of paying several taxes, except when necessary, especially on the specialized taxes, you just have to pay. If you are an individual, you pay personal income tax under the current Nigerian Tax Act, and corporate bodies will now pay companies' income tax and economic development levy if the company fit into the categories of the company that are liable to pay economic development levy. So all other taxes that I've listed here have been phased out. But we still have some specialized taxes that will remain. For instance, we have the Petroleum Profit Tax Act. Of course, that will also be phased out subsequently. We have the hydrocarbon tax, which is made up of an element of income tax and other taxes paid by upstream petroleum operators. We have also, I've also mentioned lottery tax, which is also being phased out. So the table gave a comprehensive list of all the income taxes in Nigeria, the current one, and the incoming income tax that will remain once the Nigerian Tax Act becomes effective on January 2026. So now we have mentioned that we don't pay tax on capital, we pay tax on income. So what are the income that you actually pay tax on? Because the law in defining the law did not actually define income tax. What Nigerian law did is to list the earnings that will be subject to income taxes, and also use an expansive word to capture earnings that have not been listed in the among the categories to capture the taxes. So what you normally use to determine what you are paying as tax in any jurisdiction is the concept of the tax base, which is the total value of income, asset, or transaction within a jurisdiction that are subject to tax. So for income tax, the tax base is the portion of a person's income or company's income that is subject to tax. If you look at the current Nigerian Tax Act, specifically Section 4, Subsection 1 and Subsection 2, it listed the income tax base. That is, it listed the income that is subject to income tax in Nigeria. But so by listing it simply means that there could be some income that are not subject to tax. So those are also specifically listed in the Nigerian Tax Act, specifically Section 163 sub 2, and those are the exempt profit or gains. So if the income fall under the exemption, it will not be subject to tax, even though it is not capital. as we have mentioned before, that capital are not subject to tax. Now, let's now narrow down this to corporate income tax, which is the elephant in the room. And of course, everybody is aware of CETA. Now, corporate tax in Nigeria is primarily governed by companies' income tax. So CETA imposes income tax on all the companies incorporated in Nigeria. So irrespective of where the company earn this income, as long as that company is incorporated in Nigeria and it is within the tax base, the income will be subject to tax. CETA also imposes income tax on foreign companies that earn income from Nigeria, even if those companies are not incorporated in Nigeria. So the theory is that if you earn income in Nigeria, even though you are not a Nigerian company, you will be subject to income tax. And it happens frequently. A foreign company could lend money to a Nigerian company. Foreigners that are not in foreigners or foreign companies can invest in the Nigerian capital market and earn income. So those income will be subject to tax in Nigeria, even though the foreign company is neither doing business in Nigeria, strictly speaking, but by engaging in passive investment, it earns income in Nigeria. It will be subject to Nigerian income tax. Now, the NTA has expanded the scope of Nigerian tax net by providing that companies control and manage from Nigeria could also be subject to Nigerian income tax. Even though the company is not incorporated in Nigeria, they are not really earning income in Nigeria, but they are controlled or managed from Nigeria. The central place of control or management is in Nigeria. It could be subject to Nigerian income tax. There are also some other further expansion, like taxation of income from digital and virtual assets. Yeah, we already have a regime to tax digital and virtual assets introduced by the Finance Act 2023, right? However, the current Nigerian Tax Act expanded it by setting out the clear means of administering income tax on digital and virtual operators. It also strengthened the concept of the significant economic presence in Nigeria. So, what is the rate of income tax in Nigeria? I think I've mentioned that currently income tax is charged on the taxable profit of the company at the rate of 30% for large companies. For medium companies, currently, the rate is 20%, while small companies are completely exempt from income tax. But this is due to change slightly next year. We only have medium, there's no more medium company, we only have small and large company. Small company will be completely exempt, while large companies will still be taxed at 30%. So how do you compute CIT, company's income tax? First of all, you start with the accounting profit. You first have to determine the accounting profit of that company in that particular year, and it's quite straightforward. You look at the earnings minus deducted. You now deduct all the allowable deductions, and if there are any add back or any disallowable expense that were added in arriving at the accounting profit, because sometimes accounting profit may not really be the profit that will be subject to tax because of expenses that might not have been deducted. So it has to be disallowed. So you also, like I said, you also deduct all the allowable expenses. After that, you arrive at the adjusted profit of the company. Then you still do further work by deducting capital allowances and the previous year's losses. Capital allowances are expense of capital nature, and there are set rules for capital allowance deduction. time will not permit us to do that now. Subsequently, we still have to take some of these things in detail. After that, you arrive at the taxable profit and apply the rate that I have mentioned. So we also have the education tax that we have currently that will also be phased out and will be replaced by National Economic Development, Nigerian Economic Development Levy. Is administered by the TED fund and collected by the FRS, and the flat rate currently is 30%, except for small companies that are completely exempt from education tax. Education tax, unlike income tax, is based on assessable profit. What it means is that once you arrive at the taxable, at the accounting profit and taking out all the allowable deduction, you apply the rate on the profit. So you don't, there's no capital allowance deduction, there's no deduction of the previous year's losses. So the assessable profit is simply the adjusted profit of the company before deduction of capital allowance and the previous year's losses. I set out the manner of the computation in the slide. Now, what have changed? What are the changes that we currently have in the income tax regime in Nigeria? I'm going to highlight some of them to enable us look at, have an overview of other taxes. First of all, the review of the income tax band for personal income tax. The current, the income tax currently is now applied to personal or individual income above 800,000 naira per annum, and the upper rate, the highest rate, have been adjusted from 24 to 25% of the total income of the individual. Another major introduction is the expanded meaning of Nigerian company. Previously, Nigerian company is simply a company incorporated in Nigeria, but currently the NTA expanded it to include companies that have their place of management and control in Nigeria. So if the company is being controlled from Nigeria, that company could also be subject to Nigerian income tax, subject to any treaty provision. There also been alteration on the chargeable income. I will mention one. Previously, income earned by sportsmen, musicians, and artists from other by Nigerian musicians and artists outside Nigeria are not subject to income tax. So, but currently, such income will be taxed in Nigeria. We also have the concept of taxation of the deemed distribution of income of closely held company. What the law says is that any company that has at 5 shareholders or less that have not distributed their profit could be forced to pay tax on the undistributed profit. So if the FRS or Nigerian Revenue Service that will come January is going to make rules on how deemed distribution of profit of closely held company could be taxed. We also have a comprehensive regime for taxation of virtual and digital assets. I've mentioned that before. The law also introduced what we call control foreign company. Foreign companies controlled by Nigerian company could also be forced to pay tax on their undistributed profit if the tax authority thinks that the dividend could be distributed without affecting the operation of the company, like the closely held company point that I mentioned earlier. Rules will be made by the Nigerian Revenue Service subsequently on how these tax will be applied. Of course, I've also mentioned the increased exemption for small companies from 25 million to 100 million. The threshold for payment of tax have now changed, as I mentioned. So if a company has an annual turnover of 100 million naira and less, that company will not be subject to tax in Nigeria. Previously, the threshold is 25 million naira. And of course, there's a clear exemption on professional service provider like law firms and accounting firms. So whether the turnover is up to 100 million naira or not, such company will still be subject to income tax in Nigeria. Now we have also introduction of effective minimum tax rate, and this applies to multinational enterprises and Nigerian companies that has certain that meet certain threshold in their annual turnover. NTA also provide for taxation of capital gain tax at the same rate as income tax. So for now, the distinction that we used to draw between capital receipt and the income receipt is no longer relevant because the same tax rate apply whether we are paying capital gain tax or income tax. I've also mentioned the economic development levy of 4% that will replace all other income taxes except the CIT. I also mentioned taxation of indirect transfer of shares of a Nigerian company. What this means is that any company being owned or controlled by a Nigerian company could also be taxed on the indirect transfer that occur at that level, even though the company is not in Nigeria, but it is 100% or almost wholly owned by the Nigerian companies. If they are indirect transfer at that level of the subsidiary outside Nigeria, that could also be subject to tax. And there have been expanded tax base for non-resident companies. There's also restriction of the tax exemption status of free zones companies. The NTA also introduced economic development incentive to replace the pioneer status incentives, which most of us know is the tax holiday granted to some qualifying companies. There have been reorganization on the pioneer status regime, and the name now used is economic development incentive. And instead of tax holiday, the law grant tax credit to qualifying companies. Another major change is what I can say reintroduction is the bringing educational institution, reinstating the tax exempt status of educational institution. Previously, educational institutions of public character are exempt from tax, but that will remove sometime either 2022 or thereabout by the Finance Act. Now that has been reinstated. Another major change that we need to pay attention to is the removal of consolidated relief allowance. We used to be 25% and replacing same with rent relief allowance. So these are some of the changes that we are going to witness in come January in our income tax regime. So I'm going to stop here to allow Olajimi to look at some other key, one of the key tax we have in Nigeria. After that, I'll come back to, highlight the value added tax regime. Thank you very much, Precious. Evie, are you there? Please, can you call on Folajimi to take over?
Mr. Akina, thank you very much, Mr. Steve. Mr. Akina, the floor is yours.
Yes, good. Hi, everyone. Can you hear me?
Yes, we can hear you clearly.
Yes, I'm trying to share my screen. Can you confirm if you can see my screen?
Yes, I can see your screen. Capital gains tax 101.
Great, great. Thank you. Just give me a second then. Okay, great. Hi, everyone. I hope you can see me and hear me. Yeah, please let me know if you can hear me so we can proceed. I'm seeing a lot of thumbs up. I believe that's a yes. Okay, so I'll go ahead then. I'll go ahead. Hi again. I'll be discussing the fundamentals of capital gains tax. When we had this session in 2023, we had a more in-depth discussion where we went through the entire capital gains tax act. But this session will be a bit different. My remit is to discuss the fundamentals, and hopefully in subsequent sessions we'll have full sessions on capital gains tax. So hence the subject capital gains tax 101. Now for the next 30 minutes, you have me. Please bear with me. After this session, Stephen will take over, then we'll have Q&As. So what are the learning outcomes, right? At the end of this session, I would expect everyone on this call to understand some of the policy objectives behind CGT. I'll expect everyone to know the basics of the tax, and then we'll look at some case law on tax planning, and we'll discuss some of the recent changes to the CGT regime in Nigeria. Now, this is the agenda. The presentation is broken down into 4 chapters. The first chapter will be the utility of capital gains tax. So what is capital gains tax? What's the relevance to Nigerian taxes as a whole? What are the basic principles? Under the basic principles, we'll go through specific sections in the law. Some case law is the third bit. We'll look at 3 cases. Essentially, these case laws will be talking about the difficulty in distinguishing what a revenue receipt is and capital receipt is, then the recent changes. Now, because tax, one of the major reasons for tax is to raise revenue, I thought it would be a good idea to look at this table. Now, this table is all the information here is from FIRS, right? And I wanted to focus on how much do we actually get as a country from capital gains tax? Is it a big deal or a small deal? Now, let's start from, can we start from the capital gains tax line? Sorry, the total tax line. That's the penultimate row. All the figures there in trillion. So the first row, 2024, Nigeria's tax revenue was 21 trillion naira. And that's a huge jump. If we look at the year before, where we had 12 trillion, then 10, 6, 4, and 5.2 in 2019. Now, the figures in brackets under 2021 and 2022 are because I didn't get those figures from FIRS website, but everything else is from FIRS. Now, there are blanks. The blanks are because there's no data on FIRS website, and that's because I guess the COVID years where we didn't have a robust data collection. Anyway, let's focus on this table. Let's look at the CGT line. In 2024, we had 52.5 billion naira as revenue from capital gains tax. The year before, we had 19.8. The year before, 45.57, 17.5 in 2021, and so on and so forth. Now, what I think is most interesting for me is the last row in red. And that's essentially the percentage of capital gains tax to total tax in Nigeria. We'll see that all the figures are 0.2, 0.1, 0.4, 0.2. Essentially, capital gains tax is a small fry when we compare the whole tax revenue in Nigeria. It doesn't contribute up to 1% of our total tax revenue. And that's remarkable because I didn't even realize it was this low in tax receipts. And I guess that's what explains the recent increments in the tax rate or alignment in the new tax regime. So interesting to note. I used to look down on stamp duties. I thought it was one of those taxes that was very boring. But when you compare capital gains tax against stamp duties, we see stamp duties far exceed CGT. For example, 2024 alone, there was a receipt of 238, I think is billion, vis-a-vis what we have in capital gains tax. Now, what does that tell us? I mean, there are 4 lessons for me. First lesson on that data is 1, capital gains tax is a very low income tax in the sense that the tax revenue is not so high. Now, why is it? Why? I mean, it prompts further questions for me. Why is it as low as that? One of the reasons is because we have a very low tax rate in Nigeria, 10%. And this is not really absurd. In many parts of the world, the capital gains tax rate is always lower than income tax rates. If you listen to the debates, read broadly, you'll find that many countries have now begun to ask themselves why. Because a capital gain is an income the same way we have revenue or profits. They are both incomes. So the question is, why is there a discrepancy or disparity in the rates? If you say taxes should fulfill certain roles, e.g., be horizontally equitable in the sense that if you earn, people with the same income should be treated equally, the same type of income should be treated the same way. Why is it that I have revenue receipts is 30%, but I have a capital receipt and it's 10%. Now, this sort of disparity creates tax arbitrage in the sense that people or businesses can start to shift or misclassify their revenue, right, as capital, because capital gains tax would mean they'll pay less taxes. Another reason, and we'll discuss more of this in subsequent slides. Another reason why the capital gains tax intake is low is because there's a very narrow base. Very narrow base means that when you look at the Capital Gains Tax Act as it stands today, there are a number of exemptions. I mean, the exemptions span through sections 26 up to 40 in the Act. Stocks and shares, all exempt. Stocks and shares, sorry, came back to the list in 2021 Finance Act. But you have things like gifts, almost all gifts will be exempt. Things like when you sell your principal private residence, your house, you'll be exempt. And a lot of high value assets are generally exempt. So when we look at all these things, do we now conclude that capital gains tax is a useless tax? We just scrap it out? Because when you think about it, there's also the administrative bit of it where the revenue is administering the taxes, right? So if we say, on one hand, it's a very low intake tax, is it worth all the stress of the revenue authorities assessing companies to capital gains tax? Is it worth it? The answer would be no. But that's not the full picture, right? Capital gains tax is very important because it acts as what they call a backstop to income taxes. Now, if you go back in time, right, there was a time when Nigeria did not have a capital gains tax law. What we had was an income tax law. So that meant if businesses made capital profit or a capital gain, they would not pay tax on it. It was tax exempt. They only pay taxes on their incomes. So introducing a capital gains tax means that when a company has capital gains now, which is a form of income, it will suffer taxes on those income by virtue of the fact that it's a capital gain. It's no longer exempt. So capital gains tax has one primary objective, which is to act as a backstop on income taxes. So what you lose, what the country would lose in income tax receipts, it can mop up via a capital gains tax regime. So that's the primary utility of a CGT, and that's the general rule across countries that apply it. Now, so having said that, in summary, number one, it's a low intake tax. Why is it low intake? The rate is low. The base, what you impose tax on, is very narrow because of the multiple exemptions, which we'll see further down the line. But it's not a useless tax, right? It acts as a backstop. It mops up any income taxes that the government will not collect. Just to say, I know there was a session yesterday where we had constitutional bit of it. So for the purpose of capital gains tax, the Federation, the FIRS is responsible for collecting capital gains from companies, whilst the state revenue authorities are responsible for collecting capital gains in the hands of individuals. So let's move forward to basics, right? So the tax was introduced in 1967. So again, as I said before 1967, there was nothing like a capital gain. So if I was carrying on a business and I made gains, I would enjoy it without having to pay tax. Now the rate is 10% off the chargeable gain. Now the text chargeable gain is in red because I intend to explain further what the law says about what a chargeable gain is. The chargeable gains on all capital gains accruing to any person upon disposal of an asset. So disposal has a technical term in the law, and assets are also defined in the law, and we'll look at that in further detail as we proceed. Now, tax is based on realization. Now, this means that you do not pay the tax unless you have sold or disposed. Let me say disposed. You have disposed an asset and you received the disposal proceeds. If you read the debates or the commentary on capital gains tax globally, there's always been the arguments where people would say capital gains tax is taxed more favorably than other income taxes. And one of the favorable points is it's based on realization. Now, why don't we impose tax on accruals, right? Because what will typically happen is if I know that I'll pay tax, I can just sit down my asset, right, and not decide to sell it. That way, I never get taxed on my capital gain because I never sell the asset. When I'm tired of sitting down the asset, I give it out as a gift to my son, right, or my wife, and it becomes sheltered from tax because, again, most gifts are exempt. So there's always been that debate to say, is tax on the realization the right way of doing it? Because it can cause a lock-in effect where people won't sell, where businesses won't sell, and they can pass on assets from one person to another by way of gifting. The flip side to that argument, right, would be that accruals would create all sorts of problems. Number one, if you say my asset has increased in value, right, how do you determine the value if I don't sell it? Because a sale would give us a market value, right? But if I don't sell it, then what's the matrix for determining the value of that asset? That in itself creates problems. Another problem is that you'll be asking taxpayers who may not be liquid, right, to pay taxes. So if I have an asset, it's appreciated in value, but because I have not sold, I don't have even any receipts, any proceeds. How do I then pay tax if it's on accrual? So again, globally, that's a debate on the commentary on capital gains taxes. But most countries generally would tax on realization because it makes sense. It avoids the problems of accruals, of valuations, and of illiquid taxpayers. Now, because capital gain is an income, right? The act sort of creates a bifurcation in the sense that whenever taxes are paid under capital gains tax, you don't have to suffer double tax under income taxes or income tax acts. So that's what I mean there by saying excluded from the operations of other income tax acts. So again, to prevent a case of double dipping where taxpayers can enjoy a relief under Income Tax Act and then run to Capital Gains Tax Act for a relief. Those provisions are there to prevent double dipping or double taxation. Now, what are chargeable assets, right? The chargeable assets are defined in Section 3 of the current acts. The term is defined very broadly, right? It includes options, it includes debts, includes all forms of intangibles, right? So it's a broad definition for assets. Now, any currency other than Naira would be subject to capital gains if you make a gain if you make a gain on the sale of a currency other than Naira. Any form of property created by the person disposing of it. So, for example, you create, it could be an IP, you create any asset, right? It's a chargeable asset, and any qualifying capital expenditure. So, in essence, Section 3 of the law as it stands now gives a very broad definition of assets. But as we'll go down the line, you see that a lot of these things would be exempt from capital gains tax. Now, what's a chargeable event, right? So capital gains tax only kicks in, right, when you have a disposal. So the disposal is what triggers the chargeable event. Now, let's look at the definition of disposal. Section 6 of the Act, right, defines, and when I refer to Act, I'm referring to the law as it stands today. I'm not dealing with the law in 2026. Disposal of assets means where you've received a capital sum in respect of a sale, a lease, a transfer, an assignment, a compulsory acquisition, or any other dispositions of assets, right? So again, expansive definition. Now, I recall once acting for a client, right, where the company was going through a restructuring, a business restructuring, and that meant part of the terms of the restructuring was to lay off current staff and rehire them. So what the terms provided was current contracts were cancelled, the employees received lump sums, new contracts were issued to the employees. And of course, and this industry was the oil and gas regime. So you can imagine the fat bonuses that people were paid at the time. LRS comes quickly and says, oh, they need to assess these people to personal income taxes under Peter. But then I was called to advise myself and my team. And we said, no, this sum is not subject to tax under Peter, that is subject to tax under capital gains tax. And if you look at the Capital Gains Tax Act, section 6 is broad, right? But then it has appendages which includes or which contains specific provisions. So one of those provisions is when a person forfeits a right under a contract or surrenders a right under a contract, then whatever lump sum they've received will be a gain. Now, of course, the client was happy because the rates were lower, 10%, as opposed to what they would have paid at 24%. So again, the law, capital gains tax law, is very broad in definitions, but it has specific points, which I personally call sui generis provisions, which I would advise we focus on. Because prior to that time, LRS had never, ever, ever had to assess such payments under capital gains tax. For LRS, it was a bad deal, but for the client, it was a good deal because the rates are lower. And again, it brings up that debate to say, why is an income tax capital gains lower than an employment income tax? If they are both incomes, why don't we just equalize or align the rates so there's no arbitrage on one part against the other? Now, what's a chargeable event? What's a capital gain, right? So a chargeable gain would be when you sell an asset or you dispose an asset and you receive a lump sum. The law allows you to take certain deductions away from the proceeds. So, for example, I sell an asset at 10, but before and I receive 10, right? But 10 is not my gain. I'll have to work out my gain, and in working out my gain, I'm allowed under the law to deduct the cost of acquiring the asset. So maybe I bought the asset at 4 or 6. I take out that 6 or 4 from 10. Whatever expenses I may have acquired in enhancing the value of the assets. So maybe I spend some money on insurance, blah, blah, blah. I can deduct the assets. Whatever amount I spent on preserving, defending the assets, etc. For example, let's say there's a court case and I hire lawyers to help me defend my rights or my proprietorship rights over the assets. Then those sums I'm allowed to deduct from the proceeds of sale. And finally, cost of disposal. Okay, when I want to dispose the assets, did I advertise it? Did I carry out a valuation, etc.? All the costs I've incurred, right, on that assets, I'm allowed to take deductions from the proceeds. Then whatever is left, I pay to the tax authority as a gain. So it's quite expansive. Now, under the new regime from 2026, capital allowances are one of those things where if you enjoy capital allowances on the assets under income tax acts, you can no longer enjoy that under the capital gains tax, and in the sense that once you deduct capital allowances under income tax act, whatever is left as the value of the property of the assets is what you bring in under the capital gains tax act. The essence is to prevent taxpayers from enjoying deductions or allowances under the two tax laws, such that at the end of the day, the assets, the value of the assets is so reduced and the gain is so small for the tax authorities. Now, I said before, the base of capital gains tax is very, very narrow, right? And that's because there are many, many exemptions. Now, if you look at this list, right, blah, 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 ecclesiastical, charitable, educational institution of a public character, any statutory or registered friendly society, any cooperative, and the list goes on and on. So all these bodies are exempt. Essentially, the list exempts statutory bodies and non-for-profit bodies. But under the new law from 2026, this has been amended slightly such that you have only things like, I think the law says where there's a trust involved in holding these assets, that's when you enjoy the exemptions. So the new law has gone from a place of having broad exemptions to narrower exempt bodies. So that's something to note when you compare the old and the new regime. Now, not all gains will be subject to taxes. Some of these gains are exempt. Now, under the current law, we have disposal of main residence or dwelling house of an individual. So, for example, I sell my house, right? I don't get to pay any taxes, any capital gains tax on any profits or any gain on that sale, because that's what the law says. And it's not peculiar to Nigeria. Many countries around the world have this provision. But then we've started to question this provision to say what's the real sense behind it. A lot of people's houses appreciate over time. When they eventually sell, it's like a windfall for many people. And so the question is it fair for them to keep some of the monies? Is it fair for government to get some? Yeah, that's a debate, but many countries have started to question these provisions. And I know under the new act in Nigeria, right, the exemption has been curtailed such that an individual can only enjoy this exemption once. So think about it. People have 1, 2 houses or 3 houses in their lifetime in Nigeria. Yeah, wherever in the world. If you have this exemption, it means when you sell the first house, no tax, second house, no tax, third house, no tax. I'm not pro-government or pro-tax, but the question is it fair when you compare others who haven't owned a home, right? Can we collect some of the money on the gains to subsidize low-cost housing for others? So Nigeria has capped this at once in a lifetime. So for example, if someone sells his house in Nigeria, right, he enjoys this exemption once, but sales of subsequent homes are now subject to capital gains tax. Lands compulsorily acquired by an authority. Yes, if your property or land is acquired by a government and they pay you a sum as they are supposed to under the law, that sum is not subject to the tax. Now, most gifts, as said, are exempt. Compensation for personal or professional wrong or injury is totally exempt under the current act. But under the new law, there's been an amendment. I think the cap is 50 million. So if you receive anything above 50 million for a compensation for professional wrong or injury, the 50 million is exempt, but the excess is now subject to capital gains tax. The current law says assets disposed of for not more than 1,000 naira. Well, essentially, if you sell an asset and your gain is 1,000, you're exempt. Obviously, this is a bit ridiculous because of the value of the naira and the age of the law. This is a 1967 law. The new regime has increased this to, I think, 5 million. So if you sell an asset, 5 million is exempt. And I think the excess of that amount, I think, will be subject to tax, or you are exempt totally on the 5 million. The current law also provides for exemptions for disposal of vehicles. Under the new law, there's more laxity for car owners. Now you can get those exemptions for 2 vehicles. But sorry, I don't know if what I said is correct. Disposal of vehicles, well, this suggests that it's broad. Sorry. Under the current law, it's broad, right? So if you have private vehicles, as many as you have, you can get exemptions, but the new law has curtailed it to just 2 vehicles. And so the list goes on and on and on. So the text in red are the areas where the new act has amended. Now, rule over relief. Rule over relief is something that used to be it's currently under the current law. It's a relief taxpayers get when they reinvest in assets. So for example, if I have a business asset, I sell it and I get proceeds and I reinvest the proceeds in acquiring an asset of the same kind. So I sell the machinery. When I get the money, I buy another machinery of the same class. I get something called a rollover relief. That means I don't get to pay capital gains tax on the proceeds as long as the purchase is within 12 months after or 12 months before the sale. So it's sort of a relief that you get when you reinvest proceeds of sale of certain assets. Now the assets are specific. The law lists them as building, land, machinery, ships, aircraft, goodwill. It's interesting to know that this provision has now been expunged from the new tax regime. So from 2026, we don't have this provision again. We only have it when it comes to shares, right? So when you sell shares and you cross over the threshold of 10 million gain and the value of shares you sold is 150 million, you do not get taxed once you cross the threshold. If you reinvest, you get the rollover relief. But for any other assets, it's been scrapped from 2026. Now let's look at some of the case law. As I said, it's not really easy, right, to determine sometimes what a capital asset is or capital receipt is and income receipts. And because of the disparity in the rates, right, we've had instances where taxpayers have become very, very ingenious in that they get a revenue receipt, which is taxed about 30%, and they try to misclassify it as a capital gain so they can get taxed at a lower rate. So this is an age-old debate. And we have this debate, right, because again of the disparity of the rates. Once the rates are aligned, then there's no longer an incentive for a taxpayer to shift or to misclassify a revenue receipt as a capital gain just for the purpose of gaining that extra 20% in tax. Now, these are some Nigerian cases, right? And they all date back to before we had the Capital Gains Tax Act or just after. So in this first case, the Adera was timber. What happened was the taxpayer was involved in selling timber. It was a timber company. It received $30,000, sorry, 30,000 pounds, right, from one of his customers, in exchange for allowing that customer cut timber and log on its land. So that 30,000 pounds, the taxpayer paid tax on it to the revenue at 7,000 pounds, right? Down the line, the taxpayer says, oh, I made a mistake. He now writes to the revenue to say, that amount I paid to you as 7,000 tax, it's a mistake because the money I received was not revenue nature, it's of a capital nature. So I shouldn't have paid tax on it. Please give me back my 7,000 pounds. Of course, revenue refused, and the case went to court. And back and forth from the body of appeal commissioners to the High Court to Supreme Court, and the taxpayer lost on every leg of the way. Essentially, the courts held that because this particular company had in its memorandum of association the fact that it was a timber company dealing with buying and selling of timber, and the amount it received, though it was a lump sum, it not automatically, it did not become automatically a capital receipt just because it's a lump sum. Because the argument you have from many taxpayers is that, oh, it's an isolated transaction or a lump sum payment. Because of that, it's not revenue nature, it's more capital. Again, taxpayers bring up this argument because they want to enjoy the lower tax rates. So the taxpayer lost in that case. Arbico, the second case, is very similar. The taxpayer was involved in developing property. So he bought 4 plots of land. It constructed residential accommodation on 1 plot and sold to the government. And then it said, oh, the sale was isolated. It was a one-off. And because of that, it was a capital receipt. Therefore, it should pay tax. In fact, at this point in time, 1967, I'm not sure the Capital Gains Tax Act had come into force, right? The act had been introduced in 67, but I'm not sure it had taken effect. So the taxpayer's argument, I think, here was saying, oh, that entire sum of money should not suffer taxes because it was a non-taxable capital gain. Again, the case went from the body of appeal commissioners all the way to Supreme Court. Taxpayer lost. And the decision was, the ratio of the court was, yes, you could have isolated transactions, right? Those transactions can be capital in nature and they can be revenue in nature. The fact that it's an isolated transaction does not, without more, mean it's a capital receipt. Again, the courts went back, looked through the memorandum of association of the company, and concluded that the intention of the company was to trade buying and selling of property. So the company was caught under the Income Tax Act, which meant a higher tax rate. Unity 2 was an early case. In that case, the taxpayer had received a loan from its London parent company to purchase cars. Now, these cars were sold to employees of the federal government on hire purchase. And when the hire purchase agreement ended, the company decided to pay the loan back to its parent company in the UK. Now, before payment, there was a revaluation of pounds. I think it was around £1 million at the time. There was a revaluation, so the taxpayer made some gains. Taxpayer's argument was, this gain, it's capital in nature because I received this 1 million lump sum. I shouldn't pay tax on it because there was no capital gains tax at the time. So again, the revenue contested it. They went to courts, and I think this case ended at the appeal commissioner. Appeal commissioner said the amount was not capital in nature because the taxpayer had used the monies to purchase cars which were used in the course of its business. So it was day to day. Again, thinking about it, it doesn't always seem, I mean, it may seem straightforward, but when you're confronted with a case, it's not really easy to determine what income is of a capital nature and what income is of a revenue nature. Steve, in his presentation, mentioned the tree and fruit analogy. And yes, that's what the courts would say. The courts look at the nature of the sum, right, received, and the nature of the business transaction to say, okay, what does it look like? Does it look like this money has come in because of your day-to-day business activities, or is it money that forms part of your capital base? Again, the courts have not always found it easy, so they've introduced something called badges of trade. So badge of trade is a list of things where the courts look at the frequency of transactions, the intention of the taxpayer, the nature of the assets, the change to the assets, blah, 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 blah. So for example, when I pick chain of the assets, if I buy a massive, let's say 100 or a million or 1,000 hectare of land, right? Because of the size of the land, right? And because of the amount I paid for it, it seems like a capital expense. Yeah, you can argue that it's capital expense. So what do I do with that piece of land? Do I sell it off that way? If buying and selling of land is my business, then obviously it's revenue. But if I buy it, for example, and hold it the way it is, I hold it for a number of years, it appreciates, and I sell it as a one-off, or you could say, okay, because I kept it for a while, I wasn't trading it on a day-to-day basis, then whatever money I received was capital in nature. But will your answer be different if I partition the land into smaller plots and I start selling? Again, if you look at the big picture, it's a sale of land. But then if you break it down, what type of sale is it? What's the intention of the taxpayer? What have I done to the land? Do I trade it every day? Do I carry out similar transactions? So these are the tests the courts apply. Now I must tell you for a fact, because I've gone through a number of cases, it's not always easy for the courts because they take they look at these bodies of trade, and when you look at two cases, the two cases may seem identical, but then the outcome is different. So the cases have resulted in a very checkered outcome. When you look at the facts, if you want to make a guess before you read the report to say, oh, this would be capital, you read it, then it's revenue. You apply your understanding to the next case, it doesn't always come out the same. So it's not always easy, but what the courts have said or try to do over time is to say, okay, what's the tree and fruit analogy? Are we trading in every day, or is there capital assets that is not sold but generates revenue for the company? Now, having said all that, we've come to the last part of the session, which is the new legislation. So, I mean, the changes were not so much, but with a few changes, but with fundamental consequences. And one of the biggest changes, right, is aligning the rates with income tax rates. Now, what this automatically does is take away all the opportunistic behavior or tax arbitrage where customers or taxpayers would try to move or misclassify revenue income as capital income. So that's gone with these new rates. I read the papers and I've seen a lot of arguments with respect to the capital markets transactions. And there's pressure now, I guess, to reduce the rates from 30% for corporate taxpayers to 25%. It'll be interesting to see how that goes. Another new provision is something I've called foreign transactions with Nigerian nexus. So for example, I have worked with clients where on the face of it, it's a Nigerian company, right? But behind a Nigerian company, you have like a web, a confusing or conflicting web of companies scattered across the world, some in low tax jurisdictions, some in high tax jurisdictions, just a convoluted web, right? Now, what this new provision says is if there's a sale, a transaction at the parent level or a level outside Nigeria, but has a Nigerian implication such that it leads to the change of ownership of an asset or it leads to change in ownership structures, then that income or a bit of that gain will be subject to tax in Nigeria. I know for a fact that there may be guidelines to work out what gain would be attributable to Nigeria, because if you think about it, the sale offshore is probably subject to tax in one country offshore. How then would you impose tax in Nigeria? Will that not be a case of double taxation? So there'll probably be some more literature on how it will work out. Another bit to note is something called ownership structures. So the law says ownership structures. So what does it mean really? I mean, there needs to be more clarity anyway in the law. Now, the third change, I had discussed that, is a private residence relief cap. So if you sell your house, you get exemptions for the first house. Subsequent houses will be subject to tax. The fourth one, which is quite material, is deductions for capital losses. Under the current regime, if you suffer a loss, right, you do not get the advantage of deducting that loss from your gain. So you pay your tax, whereas you've borne your loss. But under the new regime, it's anticipated that you would be able to take deductions for your losses against your gains. So I think that brings us to the end of this session. Again, it was a whistle-stop tour, and that was the remit given to us. It's an introduction to capital gains taxes. If there are subsequent sections, we'll be happy to go into more detail vis-a-vis the old and the new. Thank you.
Thank you, FJ.
Yeah,
That's a
my pleasure.
And I know we may need more time to elaborate on this. I mean, you cannot even take any of the head of taxes in a day. So combining three taxes is actually a Herculean task, and I hope the audience will understand. But we are going to share our slide, and there may be more clarification on some of the points that we skip. So quickly, we are going to move into value-added tax system in Nigeria. And like I mentioned earlier, we have spent quite some time on this, and we have just I'll have just 20 minutes to do this. I'm going to rush, but like I said, I'm going to share my slides. So we're going to look at it's just an overview of VAT administration in Nigeria. So we're going to cover here the framework for VAT. We look at the distinction between VAT and other taxes, specifically withholding tax that look somehow like VAT. So some people, we're also going to look at the VAT collection, remittance, and reporting mechanism in Nigeria. And finally, we'll look at the significant changes introduced by the Nigerian Tax Act, the VAT regime. Quickly, well, of course, I mentioned earlier that VAT is one of the consumption taxes, and the rate is 7.5% on the supply of goods and services. So, as I mentioned earlier, you pay consumption tax when you spend money to purchase goods or services. So, under the Nigerian VAT regime, all goods and services are subject to VAT, except those that are specifically exempt. Please, can you see my slide? FG, can you confirm you can see my slide?
We can see your slide, Steve.
Oh, okay. So all goods and services are subject to VAT except those that have been specifically exempt from VAT. So when you look at the old VAT Act and the current Nigerian Tax Act, it made that explicit. Of course, you know the administration of VAT is under the Federal Inland Revenue, which is going to be Nigerian Revenue Service come January 2026. And as Professor Odinkonibo mentioned yesterday, VAT is still subject of litigation or dispute between the federal government and the state government on who has the right to either impose and or collect VAT. As a matter of law, every business entity that made taxable supply amounting to 25 million has the obligation to impose and collect VAT. However, the threshold is going to change in January 2026. So now, from that time, unless you have reached 100 million threshold in your taxable supply, you are not obligated to collect and remit VAT or even register VAT under the law. So VAT was, I will skip most part of the second slide. I've mentioned that VAT is a subject of dispute. I've also mentioned that VAT Act will become ineffective come January 2026. What I need to mention is that VAT operates differently from other consumption taxes because it is imposed at various stages of the production and distribution process before you get to the finished goods. So you collect VAT as value is being added in the production and distribution process until the goods get to the final consumer. I will explain that later. So unlike what is the relationship or what is the difference between VAT and income tax? I think I mentioned that VAT is assessed on consumption or expenditure, while income tax is assessed on earning. But what I want you to understand is the distinction between VAT and withholding tax. I do get questions on this. One, VAT is a distinct tax. Withholding tax is not a distinct tax. It is a collection mechanism for income tax. So when you pay, if you are a service provider, you charge VAT on the consideration for the services being provided by you are providing to the third party. And the income, so the third party consumer will pay the VAT plus the consideration or the value or the consideration for that services to you, and you take out the VAT component and remit to the tax authority. However, if you are providing something like professional services, that service, the recipient of the service or the consumer will take out withholding tax component from the consideration and remit it to the tax authority. So in this scenario, the consumer is responsible for the collection and payment of withholding tax, while the provider is responsible for charging VAT on the invoice, collecting the VAT components, and remitting it to the government. So VAT, once you, the VAT, the withholding tax that have been taken out from the professional services is just a fraction of the income tax that may eventually due at the end of the year. So you also be given a credit note to show that on that part of your income, you have paid withholding tax. So withholding tax serve as a mechanism for collecting that income tax before the income liability will become due, mostly at the end of the year. So the amount that have been collected as withholding tax from that person's earning will now serve as a credit against the person's annual income tax obligation. Now, I've mentioned that VAT VAT is collected at each stage of the distribution and production process. So we're going to look at zero-rated item, and that is where that will become more significant. Now, if you look at the VAT Act, as I mentioned earlier, you are liable to pay VAT unless you have been specifically exempt from VAT. There are two categories of exemption. There's a VAT exemption, there's also zero-rated items. And of course, we've been hearing the chairman of the presidential committee mention basic food, these are zero-rated. If you do this, you collect input VAT claim and this. So what is he actually talking about? What he's saying, in essence, is that some goods and services are charged VAT at a 0% rate. And when you charge at a 0% rate, if that goods and services have gone through process of production and distribution before it gets to the final consumer, you may have to reclaim all the input VAT that have been paid on the purchases of that goods before the final sales. So zero-rated items are charged VAT at a 0 rate, while VAT exempt goods are not charged VAT at all. So if in the course of the production and distribution process, VAT have been charged on VAT exempt item, you don't claim anything. It is at the hand of the final consumer that exemption will apply if the law so stipulates that that product is exempt. So if you look at NTA section 1A7, you're going to see that basic food item, medical and pharmaceutical products, equipments and services are exempt from VAT. Educational books and materials, electricity generation and transmission services, tuition fees, and exported goods and services, except oil and gas export. And these products or services are clearly exempt from VAT. So VAT refund will always be claimed for or may be due for supply of zero-rated goods and services where the input VAT exceed the output VAT. In a normal circumstance, the output VAT always exceed the input VAT. But when you have a zero-rated item, the input VAT will always exceed output VAT. And in that case, you will get VAT refund. So I've also listed VAT exempt goods and services. And some of them include oil and gas export, goods for humanitarian donor-funded projects, crude petroleum, crude oil products, lands and building, goods supplied to diplomats, baby products, share passenger road transport, except Uber, locally manufactured sanitary and towel, pads and tampons, and so on and so forth. So to reiterate again, input VAT is a VAT that is business or businesses pay when they purchase goods and services for their operation. So if you purchase a goods today, the VAT that is charged on that purchase is input VAT. And if you decide to resell, the VAT that you are going to charge on the product, on the consumer or the middleman that is purchasing from you is the output VAT. So when you when you are filing or accounting for your VAT return, the actual VAT that you pay is the difference between the output VAT and the input VAT. And like I said, except in the case of zero-rated product, output VAT is always higher than input VAT. And that is what you pay to the government eventually at the end of the day. So VAT return is always VAT return, as I mentioned earlier, is filed monthly. And of course, small businesses are exempt from VAT compliance obligations. So they are not required to file VAT, unless the small business in the cost of operation eventually meets the threshold. So the liability to file that VAT return will always arise when the output VAT is more than the input VAT. So what are the key changes that we have in the VAT regime? There are quite a few, but they are very, very significant. One is a broad input VAT claim. Before now, input VAT claim is not extended to costs incurred on services and fixed assets. However, the NTA has now changed that. So if you have incurred costs in the cost of providing services or incur costs in acquiring fixed access, you can actually claim input VAT from such vatable supplies. Another significant change that we have is what most of you might have heard in the press, the sharing of VAT proceeds. The federal government probably to reduce the tension in who has a right to impose or collect VAT, has reduced its own VAT allocation. It used to be 15%. The sharing formula now stands at 10 for the federal government, 55% to the state government, and 35% to the local government. So it is yet to be seen whether this will reduce the tension between the state and the federal government on the imposition and collection of VAT. Another significant change is the fiscalization and e-invoicing. You also might have heard that there have been previous attempts to introduce a fiscalization regime or e-invoicing. However, the NTA firmly set out the statutory basis for fiscalization and e-invoicing regime, and they are piloting that as we speak, starting with large taxpayers. Another significant change in the VAT regime is the adjustment of zero-rated and VAT item. If you have looked at the current VAT Act and the Nigerian Tax Act, you're going to see that some item or services that used to be zero-rated have now been moved to VAT exempt items, while some items that used to enjoy just VAT exemption, like basic food, medical services and supplies, have been moved to zero-rated item. So there's an adjustment. It's actually a policy decision. Another significant change is on the reverse charge mechanism. Now, reverse charge mechanism is a concept that you find in cross-border VAT application. Now, when a non-resident entity supplies products to a Nigerian consumer, it's always difficult to collect VAT from the non-resident in that case, because of course, from what we have explained, is the supplier that is responsible for charging VAT, collecting it, and reporting to the tax authority. But here we are dealing with a person who is non-resident within Nigerian tax jurisdiction. So in a situation where the non-resident person failed to include VAT on the invoice sent to the Nigerian consumer, the law obliges the consumer to save accounts. You are the one making the payment for the services that you have consumed. 75% of what you are going to pay to the non-resident supplier is due to the government. So you are under obligation to do that. If the invoice sent to you by the non-resident has no VAT component to it, and you could be held liable for failure to save account and remit VAT. Now, this reverse charge mechanism used to apply to all consumer, whether resident or whether it's also a consumer, whether the supply is from a resident or a non-resident entity. The Finance Act 2020 introduced reverse charge mechanism across board. What it means then is that if you have received taxable supplies and the invoice has no VAT component, you as a consumer has the obligation to charge VAT at 7.5% of the total consideration and remit it to the government. So that's why we call it reverse charge mechanism, because it is reversing the VAT administration. This is so. Of course, this is always a problem, because sometimes it may not be the person who is receiving, the consumer may not even know that he has such obligation. And the current reform is restricting reverse charge mechanism to only supply of goods or services to Nigerian by a non-resident person. So it is only where the supplier of the services is not resident in Nigeria. It's only in that situation that the Nigerian consumer has the obligation to charge VAT and account for the VAT component. The last but not the least is the non-resident power, the Nigerian Revenue Commission power to appoint any person as collecting agent. Now, previously, the FIS has the authority to appoint the supplier or the consumer of the services as collecting agents. However, there is a broad power now for the service to appoint any person, even if you are not a party to the sales transaction, strictly speaking, as a collecting agent. When FRS started this, both Nigeria took FRS to court on whether FRS can appoint a non-party as a collecting agent, because strictly speaking, in a hair riding situation, both is neither a consumer or a supplier of services. So both is questioning the FRS part. Since I'm not a consumer, I'm not a supplier, I'm just an intermediary between the consumer and the supplier. Why are you appointing me as a collecting agent? Both lost both at the Federal High Court, and the case is currently before the Court of Appeal. Now there is now a clear statutory basis for the service to appoint any person, including a third party to the transaction, as a collecting agent. So if you are in a position to collect, or everything, you can actually collect VAT from the parties to the transaction, maybe because you are acting as you are intermediating between the consumer and the producer. FRS can appoint you as an agent, and you are bound to comply. So, so these are some of the key changes in the VAT administration in Nigeria. So, like I say, I rushed the slide because we do not have time again to attend to several questions I can see in the chat box. We are going to share the slide, and if you have any question, even after the presentation, we can take it outside here and address them. So I hand over to Precious for the Q&A.
Mr. Rubike and Mr. Kinla for that lovely session. I hope I am quite audible and visible. So we have seen the various questions that we all have dropped. So I'll basically categorize the questions in order to ensure that we answer them swiftly. Okay, so first and foremost, the first question is for Mr. Rubike. It's for small company taxation under the NTA. The three major questions that were asked were, first, the whether small businesses like legal practitioners and accountants are taxed, accountancy firms are taxed under the NTA 2025, and also on small company taxation under NTA. Yes, and agricultural companies, how they are placed under the new tax laws. So I think that's the first question. Should I?
Yeah, they do. There are 2 questions, right?
Sorry, sir, please can you come again?
Yeah, you have asked 2 separate questions and they are not actually related. Can I address them before you go to the third one, so I don't lose the track?
Yes, sir, please.
Yeah, the first is whether lawyers and accounting firm, small entities are liable to tax. Yes, they are. So in fact, there is an express exclusion of professional service providers like lawyers and accountants from that definition of a small companies or small businesses. So they are liable to tax, and they, irrespective of the turnover, irrespective of the profit, they are liable to tax under NTA. They are not in the category of small businesses or small companies. It is very, very express in the NTA. So they technically exclude us. Of course, the reason is quite clear. You know, by the nature of services, we are not utilizing, maybe we are not in the production process where it's not a heavy, it's not, service providers are not like people producing goods and services where there is always high turnover. So we operate under a very scaled, is a more or less scale operation. So lawyers are not classified as small companies or small businesses. And of course, we are not even companies. We operate we operate as business, as sole practitioners or partners. That's one. Now, secondly, the agricultural companies or businesses companies in business in agricultural businesses are exempt. However, there's a limit to the exemption. They enjoy minimum tax. Or rather, they are exempt from tax within the first 4 years of their operation. So the exemption is not indefinite. After the first 4 years, if you are not, if you are still, if you are making profit, you still have to be liable to pay taxes. So it has a limited exemption based on the number of years of operation. Richard, I can't hear you.
Sorry, can you hear me now?
I'm just hearing you now.
All right. So the second question is on the scope of unearned income under the Nigeria Tax Act. Different people ask, how is parents to children and children to parents, how is that income? It's unearned income. How is it taxed under the Nigerian Tax Act?
Well, money to the family, money that maybe a parent gave to the children is not part of the taxable income in the tax base that I mentioned. If you look at Section 4, subsection 2, it mentions income, profit, or gains of individual that will be subject to tax. Employment income is there. Then we have pension, annuity, and other similar income. Then we have income of a family recognized under the law or custom, maybe family that has, say, a family building where they rent it out to tenants. That also come under taxable income or profit for individuals. Then we have income arising under a trust or settlement or estate of an executor of a deceased person. So to the extent that the unearned income that a parent gives to his or her children is not recognized here, it will not be taxable unless it arises under employment. Of course, some people employ their children in their business operation. If it is employment income, strictly speaking, it will be taxed. But if it's not an employment income, it will not be taxed. For example, if you are a student and your parents send you money regularly, let's say monthly or bi-monthly or weekly, that income will not be subject to tax under NTA. Thank you.
All right, thank you very much, Mr. Ribike. The next question was a particular question you indicated that you would love to answer, which is on chargeable income for small company, whether it can be classified, whether statutory fees are categorized as chargeable income.
No.
If it's not clear, I can go ahead and read the question.
No, statutory income from our definition of earning of income as earning. If your client gave you statutory fees, it is not your earning. It is more like an expense. If you are even to look at it from that angle, it is not an earning to the company. It is more like a service that you are. You are acting in an agent capacity. You are more acting like an agent because ordinarily your client should be the one paying the statutory fees to the government or to the regulator. So if they credit your account to make that statutory fees on the client's behalf, that income will not be subject to tax. It is not among the income listed in section 4.1, and of course, it could not. The tax, the draftman could not have listed such income as a taxable income because it is not even that of the company that is paying it to the regulator. It's not taxable.
Thank you very much, Mr. Ribike. I think that would be all questions for your part. The subsequent questions were asked during Mr. Akinla's presentation. But some others are coming now. Go ahead, Mr. Akinla, answer first. Mr. Akinla, please, are you here? Are you still here?
Steve, can you take the questions? I don't think that.
No,
Yeah,
you
which
can
one?
ask,
Sorry.
you can just ask the question.
What
Okay,
questions do you?
back.
Yeah. Okay. So, what is there any question in particular? So, I'm going through the list now. I'm going through the list now. Okay, I see one question.
The first question that was asked.
Yeah. It says capital gains tax and other transaction-based taxes are usually low when economic activities are low or slow. It's not really about the rate itself.
That's a comment.
Yeah, but I mean, to respond to that comment, right? There are two parts to the question. The first part is for me to say, usually the capital gains tax is not transaction-based, right? I mean, when I think of transaction taxes, I'll think of VAT and withholding taxes. Right, so that's one part of the question I want to clarify. There's also another bit of the literature where it says if you increase capital gains taxes, right, you discourage entrepreneurial risk-taking activities, right? So, for example, if capital gains tax is moved up higher, then people would be like, I mean, what's the point? I mean, I'm not going to invest because my tax rate is now higher, and they would enter what I called the lock-in effect, where you don't sell your assets, you don't take risks because you know that you will suffer a high tax. So it's not just merely low economic activities. I'll agree with you to a point where, for example, in 1998, Nigeria suspended capital gains taxes on stocks and shares. The reason was, there are a couple of reasons for that. Number one, to make cost of government loans lower, right? Because government will be more expensive with the tax on. Secondly, was to encourage activities in the capital markets. So it was exempted. So it wasn't a question of the rates being increased or reduced. It was just exempt. So to that, I see where you're coming from. Going further down, there's an argument that says if you capital gains taxes are generally kept low because capital gains tax sometimes can be seen as being a tax on inflationary gains. So what do I mean by that? So I have an asset today, right? due to no effort of mine, right, the asset just increases in value because of inflation. Are you saying I made a gain when I sell it, or it was just because of inflation? And there are cases like that where you say I didn't do anything to the asset just appreciated because of inflation, right? In that sense, I can argue that, oh, this gain is inflationary in nature, right? So what you're taxing really is not a gain that I made, but you're taxing inflation. So it's not a real gain. So that's why you have many instances where a capital gains tax is reduced or is set moderately low to other income taxes. And there's also debate on lobbying, right? So if you look at it, right, and this is specific to individuals, those who would have the highest capital gains taxes to pay are the high net worth individuals. Think about it, because they are the ones selling they're the ones that own the high value assets. When they sell the high value assets, they make a gain, right? So there's a literature that says capital gains taxes may be low because you have the 1% of the society influencing the government to introduce taxes in their favor because they can influence taxes, right? So it's not a question of to say, oh, it's low business activity. No, there's literature that does not support your case. Literature that says if you increase taxes, you drive down entrepreneurial risks. But I agree with you to an extent where if government wants to introduce a policy, for example, or to stimulate growth in an area, they can suspend the taxes just so that economic activities can be stimulated in that sector of the economy. So that's the only point. I hope I've answered you, anonymous and attendee, but we can always engage outside this forum. Is there any? I'm scrolling down now to see if there's any other question. Bamdele says, if I bought a house in 2020 for 100 million and sold it in 2025 for 200 million with CGT taking into account Naira. So the law as it stands today, you'll be exempt if it's your private house, if you live in that house. I mean, I think the language of the law is principal private residence. You'll be exempt, so no qualms. But if you don't live there, the law as it stands today will not take into account depreciation and current will not take into account depreciation of Naira. You only be able to deduct your expenses, what you've spent in bringing the house up to date, etc. And it's sort of linked to the question I asked, the answer I answered now about inflation. But no, you won't take into account. What I did not mention was that in other countries that have capital gains tax, they have something called indexation allowance. An indexation allowance gives room for inflation. So if there's any inflationary gain on your proceeds of sale, the law sort of works out an allowance for you to reduce the value so you don't lose on inflation. I think other countries have something called, I can't remember what it's called, but there's indexation allowance. Is an inflation relief anyway. So that happens. So you will not be able to take account depreciation. Long story short. Yeah, I think that's all on capital gains tax. Someone says, Amalara says, will double tax treaties help clarify conflicts? Yes, they will. So double tax treaties would help clarify nexus questions. But double tax treaties will only be useful where you have a double tax treaty in existence. Nigeria has about 14 or 15. So you can imagine it's so small compared to other countries. So you'll be lucky if Nigeria has a double tax treaty with a particular country that is also connected to that transaction.
It's more than that now, Jimmy, with the ECOWAS treaty, double tax treaty are in fact double almost what we have before, because all the 15 ECOWAS nations are now part of that
Yes.
treaty.
Yep.
So when you
I
add it
agree
up,
with you. I agree with you. You're
right,
correct.
like that.
I agree with you, boys. It's African based. I don't know any.
Yeah. I understand, but I mean, it's made for the purpose of. I mean, they adopted it quickly for the purpose of African continental free trade zone. So
Yes,
it's
yes,
useful in
yes,
future. Who knows?
yes, correct, correct. I mean,
Yeah.
I just assumed Omolara was asking a question with respect to Nigerian companies that have offshore parents. I don't see offshore parents being in Africa. I'm seeing them being in parts of the West, maybe in other parts of the world. But yeah, I agree with you.
Totally agree. And I think that question relates to things like control foreign companies
Exactly,
regime
CFC rules.
and
Yeah.
indirect taxation of offshore transfer. I mean, whatever we have under the NTA, we still have to is subject to treaty arrangement, as I mentioned earlier. So if there's
Yes.
a tax treaty, it's not only what the NTA says that will prevail, it's actually what the treaty instrument between Nigeria and the treaty partner says that will regulate the or that will resolve the Nexus problem.
Yes. Thank you. There's one question from Samuel that talks about chargeable gains. Yes, I explained chargeable gain to say you have your and I guess I explained it in the context of computation, right? To say when you get your proceeds of sale or disposal proceeds, that sum is not the gain, right? That sum enjoys certain deductions. What you have left after the deductions is what is the chargeable gain. Now, in the context of virtual and digital assets, I don't think there's any. You just have to work out what the current law says vis-a-vis, this asset, for example. Let's assume it's an IP. What did you spend in developing the IP? Have you had to register the IP for protection? Have you had to defend the IP in any way? How have you enhanced the IP with respect to making it more valuable? Those costs, yes, you take deductions against whatever gain you make upon sale, and then you arrive at your chargeable gain. So I did mention chargeable gain, but not specifically in the context of virtual and digital allowance. But there's a part of the law that was on the slides that talks about enhancing, defending, and protecting. Those parts usually would apply to intellectual properties as well. So whatever cost you incur on those, you can deduct them from your disposal proceeds before you arrive at your gain. I'm happy to share the slides, and you'll see chargeable gain in those slides again, but not specifically on virtual assets. So I'm scrolling down again.
Let me attend to this question by Professor Felicia Moyi.
Okay.
The question says, how do you classify the tax paid by a person on consultancy conducted for a foreign company or agent? If a person, I believe, is an individual, well, it's still income tax. If you if you have done, if you have conducted a consultancy services for a foreign company, it is an income tax for an individual, and if the entity, because a person can also mean a company under the law, it will be a company's income tax in that case. So, is the tax in question is income tax. However, because you are providing services, VAT will not apply. The reason why VAT will not apply here is that services qualifies as an exported services, and under the VAT Act, exported services is not services rendered to a company outside Nigeria qualify as exported services, and it will not be charged in Nigeria, because in VAT, what we apply here is a destination principle. We charge VAT on the place where consumption takes place. So consumption here is taking place in the country where the company is resident. So VAT will not apply. What we are going to have here is purely income tax. Personal income tax if the provider is an individual. Company's income tax if the provider or the consultancy services is a company. Prof, I hope I've answered your question.
Okay, thank you, Stephen. There's another question from, I just saw that question now. Hold on, I think it's, yes, from anonymous attendee that says, please, can it be restated how double dipping is prevented under the NTA? So what I said about the NTA is, you have a capital asset, for example, like a business has like machinery, for example, and you enjoy capital allowances on that machinery, right? Now that's a form of a deduction, right? I mean, if you look at it broadly speaking. Now, if an asset enjoys capital allowances up to a point, when you're going to account for it under CGT, when you sell it, right, if you don't take account of the capital allowances you've enjoyed under the income tax law. It seems as if you'll be getting incentives on both taxes. So what the new law says is, for the purposes of CGT now, you would look at the capital allowance you've enjoyed, right? And you take that value as the value under capital gains tax. That way, you've enjoyed capital allowance on one end, and you carry that value to capital gains tax act. So you don't enjoy the bloated value the asset would have under the capital gains tax act. That's what I mean. The
There's a
question.
question here by Kenneth. Can I go
No,
ahead with that?
let me
Or do you
answer.
have
Sorry, he has two
okay,
legs.
go
He
ahead.
has two legs.
Go ahead.
The other leg says, also in the scenario, why was the revenue classified as CGT? So the revenue was classified as CGT because, I said the provision, the definitions in Capital Gains Taxes Act are broad, but then it has specific appendages in the subsections that gives you specific instances where a capital gains tax would kick in. And one of those provisions is forfeiture or surrender of a right under a contract. So my argument then was, these are employment contracts, right? An employee has different rights under a contract. It's not just right to receive salary. There are other rights that the employee can enforce. But if the employee is compelled or has to give up those rights, surrender them for any reason whatsoever, then that's a forfeiture, a surrender. Now, any gain or any inflow that is tied to that surrender is, I argue, under the Capital Gains Tax Act, because the law says any forfeiture or surrender of a right. So in summary, I give up my right under the contract because the law says if I forfeit it, it's a capital gain. I think it's section 6(1)(c) or section 6(2)(c), but have a look at it. Again, we can have a chat after this if you're not satisfied. Anonymous
Yeah,
said,
maybe let me answer this before you proceed.
please go ahead. Please.
It's a bit funny, but I mean that's the reality. That's the reality of our society. Can I pay tax on a condolence money if it runs into millions? Wow. Well, if you pay condolence money running into million or billion, ordinarily it will not be taxed because it is not earning on any it is not earning arising from economic activities. It will probably be classified as a gift. But of course, you see, it is better for you to actually have documentation when you are making sort transfer, so as the intention will be very clear. Because once a taxman sees money into bank account running into million or billion, the assumption will be that the money came from economic activities. So you have to explain in that case. But once you have given credible explanation, it will not be taxed. FJ, go ahead, please.
Okay, thanks. Okay, thank you. There's one more question from Anonymous that says, CGT is a tax on profits gains made on an asset. How do the tax authorities know the so it's self-assessment, right? So you would have to comply as a good law-abiding citizen, file your tax returns, and you would self-assess, you declare, you state the gain, you compute your deductions, what you've incurred in the asset, and then whatever gain you apply the tax to. So
yeah, also in addition, if you are operating a company, of course they look at your financials, which will disclose your earning. And I may also say that even though the tax authority will not tax all the money in your bank account, but they have access to your bank account. It's in the law. They can ask for your bank account and they can track money that is entering into your account, and may call you to give explanation. Of course, in that case, you can be able to explain what actually happened.
Yes, thanks. Yes. There's another point from anonymous attendee that says, you also mentioned that the tax is paid on the lump sum received. What if the payment for the asset was made in installments by the buyer? And I reckon this is in relation to one of the cases I discussed. In one of those cases, right, I think it was Adera was timber. The taxpayer received £30,000. And what the taxpayer did was say that the amount was rent for 5 years. So what the taxpayer did was break down the rents, break down the sum to say it's £6,000 per annum for 5 years. Going into the facts of the case. But your question is real, because we've seen many instances where a company would receive a lump sum, but try to structure the payment so that it spreads across, so it seems like revenue. And that's why I spoke about the badges of trade, which the courts have adopted. So it's not just one test. There's no bright line test. The courts will look at all those 9 factors to say, and the reason is to give a holistic view to say, okay, it's a lump sum. Okay, check. What's the next step? What's your contract like? Because in all these cases, if you read the cases, again, the citations are on the slides. The courts actually went to the contracts of the transaction contracts and other documents. So if the contract says you receive a lump sum, but then we can tell from the lump sum that it's for certain periods or it's over a period of time. All those considerations come into place. And that's why I said that it's not been an easy distinction for the courts to make. And you would only know if you pick up the cases to read. You'd see 12 cases or 50 cases, very similar facts, but no principle really comes out. There's really no clear pathway. I remember one of the early cases is called Edwards and Bairstow. It's an appeal court case, the UK appeal court. And what the court did, I think it was Supreme Court. The Supreme Court says they will not even get involved, right, in looking at the questions of facts, because those are questions for the lower courts. And since that time, a lot of cases followed that principle, where the courts will say, oh, as the lower court looked at it, I can't go into the facts. And the rationale for some of these courts was because they didn't want to have to deal with the problem of, okay, what did the facts actually say? So they left it they relied on the determination made by the lower courts. I think it was Abrico FBR made specific reference to Edward.
Abrico, yes.
Yes. So again, your question is spot on, anonymous attendee. These cases happen in real life, but it's for the courts to go through the badges of trade. It's for you to have your documentation rights. But in many cases, it's clear that the taxpayer is just trying to get a better tax rate, and that's why he's going through these gymnastics.
FG is very it's a practical thing that we do for tax plan. Of course, if you can design your business to take advantage of any exemption in the law or a reduced rate, why not? It's allowed.
Yeah. As long as
it's permissible under the law. So there's really no issue. But if you have not done it properly, and then the intention manifest artificial or fictitious transaction, so it will be struck down.
Yes,
it will be struck down. There's a question by Nnamdi on the answers or the answer I've given regarding agricultural companies. He asked whether it applies to existing companies or to newly incorporated one. It can apply to both existing company. It can apply to existing company as well if the existing company have not been operating for up to 5 years. Because if you look at the exemption under the NTA, it says it is applicable to the company for the first 5 years upon commencement of business. So from the time the agricultural company commences business, is going to enjoy tax exemption. But if that company have been operating or have been existing and doing business for more than 5 years, the exemption will not apply to it. It is only limited to those that have been doing business for only 5 years. So after 5 years, you pay your normal tax.
All right, Mr. Ribike, anonymous attendee also asked whether lawyers pay company and income tax.
No.
They pay one of the two.
The answer is no. Well, by our rules, we are not companies. We fall under partnership. So it's under we pay as individuals. So how do they tax partners? They tax partners on the income accruing to each of the partners.
All right. Thank you very much, sir. And also, there's only one
so
thing
everything that we have said about personal income tax apply to law firm. Whatever I've said to CIT does not apply to law firm at all. Thank you.
Thank you very much, sir. You were also asked whether consumption tax is still valid in Lagos.
Whether it's still valid?
Yes.
Well, it's still valid. We have law. We have I don't know, when we say consumption taxes, there are several taxes under consumption taxes. We have import duties. We have export duties where applicable. We have VAT. We have custom duties and so on and so forth. So it will be more clearer for the person to ask to specify the consumption taxes. But the one that is under this that is disputed is a value added tax. Being imposed by the federal government. And we also have a hotel consumption taxes law for Lagos State and some other states. And Professor Dinkoni also mentioned the recently enacted law that imposes a consumption or hotel, or what they call, is it purchase tax or whatever, in Enugu State. These are all consumption taxes. So if you have a particular consumption tax in mind, please let us know. And if you feel uncertain about the validity, let us go to court. Thank you.
Okay, I think we've run far. We passed our time for the day, which was 5 p.m. So I think it's now time to bring the session to a close. Just to remind everyone that we've got our link for our YouTube channel showing on the chat box. And those who want access to the slides and indeed the recordings should please subscribe to the YouTube channel. Thank you very much. So now, what a day. And what an amazing set of presentations we've had from Steve and from Falajimi. And thank you, Precious, for also moderating. Steve, what a brilliant presentation as always. Thank you very much for what you do. Thoroughly enjoyed it myself. Falajimi, the same. I think it was good that both of you came in together. I think anyone who participated would have picked up a lot today. Quite loaded and quite informative. And I particularly enjoyed also the question and answer sessions. Thank you for the brilliant presentations. I just want to say to everybody that we owe a debt of gratitude to Steve and to Falajimi. I mean, I know how busy Steve is, and I also know Falajimi is outside the country now and very busy, but they have always supported the initiatives of the MBA ICLE and now the Practical Training Academy at all times, participating in these training sessions at no cost to colleagues or indeed to whatever company or organization that organizes the training. So in this case, TPTA, previously with the MBA ICLE. It's been an interesting time with this tax faculty. Steve, thank you for coordinating. It's been, I know it hasn't been easy doing all the coordination and bringing people together, but I must say a big thank you to you. And for Vladimir, I hope that by the time we see you again, you'll be back in Nigeria. so thank you.
I never left. I never left now. I never left. I have one leg in, one leg out.
You're operating digitally.
You are pushing pound sterling. We need you here.
Where do you pay your tax? Where are you tax resident now?
Where are you tax resident?
I'm 50-50.
So the English guys who want to take all your money, now the Nigerians are saying you got them on idea. So it's terrible. So no worries. Thank you very much, guys. It's always a pleasure to do this with you, and I can't just express our gratitude enough. So thank you. Just to everybody, the 4-day training ends tomorrow. I hope to see you all tomorrow. Dr. Kolo and Mr. Lasisi Phillips will be here to take us on the final session. And I know that Steve joins every day. It would be nice if Fola joins if you have the time too. But thank you guys, and God bless you. And God bless you all for attending. Thank you. See you soon.
Thank you, Tabenna and the Practical Law Academy for the opportunity. Thank you, Precious,
thank
for
you
the
all. Thank you all.
wonderful moderation.
Yeah, Precious, thanks. Thank you all. Have a good evening.
Okay, guys. Good evening, guys. Bye-bye.